Energy markets recalibrate as geopolitics reshapes supply calculus. Possibility of an end to Ukraine conflict sees crude oil slide to $60. Author K. Ravindran. Oil prices slipping below $60 a barrel for the first time since February 2021 and a sharp easing in European gas prices mark more than a cyclical downturn in commodities. They signal a rapid repricing of geopolitical risk at a moment when diplomacy, rather than escalation, has begun to dominate market psychology. The roughly 16% fall in European gas prices since mid-November and the renewed weakness in crude have followed indications that sanctions on Russian oil companies could be eased if negotiations to end the Ukraine conflict gain traction, a prospect reinforced by President Donald Trump's assertion that a settlement may be closer than at any earlier stage of the war. Markets have responded less to concrete policy changes than to shifting expectations. Since early 2022, oil and gas prices have carried a substantial geopolitical premium tied to fears of supply disruptions, embargoes, and the fragmentation of global energy trade. That premium is now being unwound. Even the suggestion that sanctions relief could be placed on the table has been sufficient to reset price assumptions, particularly in Europe, where gas markets remain acutely sensitive to political signals after the loss of most Russian pipeline supplies. Crude oil's move below $60 a barrel reflects a confluence of this geopolitical repricing with an already fragile fundamentals picture. Global demand growth has slowed, especially in Europe and parts of Asia, while supply from non-OPEC producers has remained resilient. The United States continues to pump at near-record levels. Brazil and Guyana are adding incremental barrels, and inventories in several OECD countries have been rebuilding. Against that backdrop, the potential reintegration of Russian barrels into a more normal trading system has had an outsized psychological impact. Russian crude has never fully disappeared from the market, but sanctions forced it into discounted sales, longer shipping routes, and a narrower pool of buyers. If restrictions on Russian oil companies were lifted or relaxed, Moscow would gain greater flexibility in production and exports, while buyers would face fewer compliance risks. That prospect alone implies a narrowing of discounts on Russian grades such as Urals, a development that would raise Russia's realized revenues even if headline prices remain subdued. For the broader market, it would mean an effective increase in available supply and a reduction in the inefficiencies that have tightened balances over the past 3 years. European gas prices tell a parallel story. Although Russian pipeline gas is unlikely to return to pre-war volumes in the near term, any diplomatic thaw reduces the perceived tail risks that have haunted the market since 2022. Europe has invested heavily in liquefied natural gas, import capacity, storage, and demand reduction, making it structurally more resilient. Yet prices have continued to embed a risk premium tied to fears of prolonged confrontation with Moscow. As talk of negotiations gains credibility, that premium has eroded, contributing to the sharp fall in benchmark gas prices despite the approach of winter. President Trump's remarks about the proximity of a resolution have amplified these dynamics. Markets tend to react strongly to statements from U.S. presidents, particularly on issues with direct implications for sanctions policy. Even without formal announcements, such comments shape expectations about the future stance of Washington and its allies. Traders, refiners, and utilities are not waiting for treaties to be signed. They are adjusting positions based on the probability that the geopolitical environment in 2026 and beyond could look markedly different from that of the past 3 years. The implications extend well beyond short-term price movements. Within the OPEC Plus alliance, the potential lifting of sanctions on Russia would fundamentally alter internal incentives. Since 2022, the group's production management has been shaped by the need to accommodate Russian output constrained by sanctions and logistical challenges. Moscow has had strong reasons to cooperate with supply restraint, as higher prices helped offset the discounts it faced and supported fiscal revenues during wartime. If those constraints ease, Russia's calculus changes. With greater access to markets and a narrower discount on its crude, Russia would be better positioned to increase production and exports. That shift would put pressure on the cohesion of OPEC+, particularly as the group approaches the planned pause in the first quarter of 2026. The likelihood of a return to a market share strategy, rather than strict price defense, would rise. For producers with spare capacity and lower costs, the temptation to defend or expand market share in a looser geopolitical environment could outweigh the benefits of coordinated cuts. Saudi Arabia, the de facto leader of OPEC+, would face a more complex balancing act. The kingdom has shouldered a disproportionate share of output restraint in recent years to stabilize prices, a strategy that has come at the cost of lost volumes. If Russian barrels re-enter global markets more freely and non-OPEC supply continues to grow, Riyadh may find it increasingly difficult to justify unilateral cuts. A shift towards protecting market share would likely keep a lid on prices, reinforcing the bearish tone already evident in crude markets. For energy-importing economies like India, the immediate effects are largely positive. Lower oil and gas prices ease inflationary pressures, improve trade balances, and provide central banks with greater policy flexibility. Europe, in particular, stands to benefit from sustained relief in gas prices, which have been a major drag on industrial competitiveness since 2022. Energy-intensive sectors such as chemicals, metals, and fertilizers could see improved margins, while households would face lower heating and electricity costs. Yet there are also longer-term uncertainties. A prolonged period of lower prices could dampen investment in upstream oil and gas projects, especially in higher-cost regions. That risk is particularly relevant if producers anticipate a renewed market share battle that prioritizes volume over price stability. Underinvestment today could set the stage for tighter markets later in the decade, especially if demand proves more resilient than currently expected. The energy transition adds another layer of complexity. Lower fossil fuel prices can slow the adoption of renewables and efficiency measures by reducing the economic incentive to switch. At the same time, governments facing reduced energy costs may find it politically easier to maintain or even strengthen climate policies. The net effect will vary by region, but the interaction between geopolitics, prices, and the transition is likely to remain a defining feature of energy markets. What is striking about the current episode is the speed with which sentiment has shifted. For much of the past 3 years, energy markets were dominated by worst-case scenarios, escalation in Ukraine, tighter sanctions, and deliberate supply curbs by major producers. The present sell-off suggests that traders are now assigning greater weight to de-escalation, normalization of trade flows, and a more competitive supply. Whether that optimism is ultimately justified will depend on the outcome of negotiations and the durability of any political settlement.